So, is inflation really going to help you save on your taxes? That was kind of the story that was being bantered around by the mainstream media. And so we've got some thoughts on that, plus an explanation of exactly what all of that means. Plus, we're going to share with you some of the disturbing results of a recent Wall Street Journal investigation. I don't know if you've been following this. Well, folks at the Wall Street Journal have been running a number of articles based upon this investigation that they did, investigating into the stock trading patterns of federal officials. So you may have a little indigestion with your breakfast here on Sunday morning once we share those results of that Wall Street Journal with you later on in the program. Pretty disturbing stuff that hopefully opens up a little bit more of a conversation of what we should expect, not just from our politicians, but from our federal officials. So welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. Of course, this past week, kind of hard to get good peace of mind. Another choppy week, to say the least. This ongoing battle that we've been talking about for many months here on the program between interest rates and inflation. It seems that the markets sort of ebb and flow depending upon who's winning that battle, if you will. And so the suggestion that has been sort of popping up of late, particularly over the course of the past week, is that at some point the Federal Reserve, after its next meeting at the beginning of November, may very well sort of hit the pause button. I don't know if they'll go quite that far, but maybe stop raising rates at 0.75% per clip. That in itself would certainly help to produce a little bit of clarity in terms of the rising interest rate environment. I think there's a growing school of thought out there that says, hey, wait a minute. And this is something we've been talking about for several weeks now on the program. If interest rate cuts or interest rate increases, and cuts for that matter, works both ways, take about 6 to 9 months to actually have an impact in the economy, then pretty much the only one that's really having an impact is the one that they did in March. So any of these other ones that they've done, it hasn't really had an opportunity to sort of percolate into the system. So there's a lot to be said for that notion of, okay, we get it. Okay, inflation incredibly high. Federal Reserve needs to raise interest rates to help sort of buffet that. But at some point, you got to see kind of what the impact is and how it's all sort of checking itself out. And so that notion of perhaps the Federal Reserve really helping to sort of take a moment or a pause or maybe not stay on the same route really helped sentiment in the markets. Remember, as we like to talk about volatility works both ways, both up and down. This past week, it was the up sort of won, if you will. In fact, it was a relatively strong week in the markets. Overall gain of close to 5%, best week in the markets since June. Sort of continues that upward trend that we've seen so far in the fourth quarter that started on October 1. Remember, volatility is the cost to a better return, right? If you don't want volatility, then you're not going to get much of a return. And I saw a statistic the other day that I wanted to share with you this morning that ultimately I think sort of underscores that. If you look at the markets over the course of the past 50 years, and stop and think about that, 50 years, that there's a lot of headlines in there that were quite disturbing. The reality is that over that same period of time, the overall markets measured by the S&P 500, annualized return during that 50-year period of time was a little bit over 11%. So pretty good stuff. What's interesting, though, is that if you look at that performance over time and you break it down by day, okay, what you will find is despite an 11% annualized return over the trailing 50 years, you will find that only 53% of the time on a single day basis does the market go up. The other 47% of the time, the market goes down. So some interesting data when you start thinking about 50 years of data and how the market's performed over that time, and then taking a step back and looking at it on a day-to-day basis. That's why we think it's very difficult to be consistent as an investor, because all too often we're focused on today. And if you're focused on today, 47% of the time, the market's going to go down. So 47% of the time, or just about half, you're going to be distracted. And I can tell you the way the media works is that the negative always sells better than the positive. So the negative days are going to have much more of a conversation in the media. It's going to get your attention more. And at the end of the day, it's going to serve as a distraction. But remember the split. It's much narrower than people think, considering how well the performance has been over time. But that's all it takes. Just a few more positive days versus negative days, and voila, an 11% annualized return over the past 50 years. So some interesting data there. Stop and think about that. 100 days in the market or 1,000 days in the market, 53% of them are up, 47% of them are down. Very easy to get distracted, that is for sure. Similarly, this past week, Treasury yields went to 4%. That's the 12th consecutive week of increases in the yield on Treasuries, the longest streak since 1987. Interestingly, or maybe not so interestingly, given where rates actually are, we're seeing a little bit of a sort of a difference in terms of where that is getting reflected. And we're going to talk a little bit about something that we probably haven't talked on the program about for many, many years, because these types of funds were basically dormant, or effectively dormant, because they were at 0%. If you start to look at mutual fund money markets today, you're going to find something pretty interesting. See, mutual fund money markets are very different than bank savings accounts or money markets, right? The bank one is always going to have the FDIC guarantee. The mutual fund one is not. And therein lies a difference, no question at all. I'm not trying to ignore that difference. That is a difference of significance. But when you think about what's happening in terms of rates that you're getting on your savings account or your money market account at the bank, they really haven't moved those rates that much, particularly when you stop to think about where interest rates are. On the other hand, when you look at a mutual fund money market account, those rates have a tendency to move almost in lockstep with the interest rates. So guess what? The rates are much higher. Today, typical mutual fund money market paying about 2.5%. So certainly something to be thinking about in terms of cash and what to do with it, particularly as we see the interest rates now start to get reflected in the returns on mutual fund money markets. We're going to take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So imagine that, mutual fund money markets, which basically have been paying zero for the better part of a decade. Of course, when I started in the 90s, they were paying actually 5%. Today, they move their interest rates pretty much in lockstep with the Fed. So you can certainly find interest rates and yields on mutual fund money markets these days of between 2.5+%. So that's pretty good, because clearly the bank side of that hasn't really kept up with those increases in interest rates. That's kind of one of the big quandaries out there right now. Like, why is my savings account or my bank money market only paying 1, maybe 1.5 when the Treasury yield is above 4%? That doesn't make any sense. And so consequently, though, you're seeing that much more on the mutual fund money market side of things. Now, remember, there is a difference. One is FDIC insured. That's the one at the bank. The mutual fund one obviously is not. But the difference between 2.5 versus 1.5 or 1, that's starting to get a little bit more of a spread. Combined with the fact that mutual fund money markets usually have some easy features of use. A lot of them will allow you to have a checkbook, things like that, where you can actually write checks out of that money market account. So it might be something to be thinking about in terms of cash savings that you have. Certainly one of the questions we're getting a lot of in terms of cash savings is the conversation about I bonds as well. We encourage you to check out our podcast of a couple of months ago where we went into great detail about those. Certainly a good option, nice interest rate for sure, but understand that there are some limitations, particularly the amount of money that you can put into them on an annual basis is only around $10,000, and you've got to buy them directly through the Treasury. So just some thoughts on all of that. Now, given the activity last week that pushed Treasury yields above that 4% level. Similarly, a lot of conversation this past week, particularly in the mainstream media, was how inflation is going to help you save on your taxes. I'm not sure quite drinking that flavor of Kool-Aid, but here's sort of what's going on. Every year, the folks at the IRS adjust their stuff, their income tax brackets, the standard brackets, all of that stuff for inflation. So there's about 60 different tax thresholds or numbers or provisions that ultimately get adjusted for inflation. And unless you've been living under a rock, you know that that had to be a pretty good adjustment given that inflation is 8% plus. So we're going to talk about what these adjustments mean and what they are coming up in this part of the program. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So if you missed the live show coming to you from our Nelson Financial Planning Studios here on Sunday mornings, then you can always check us out at your convenience on your favorite podcast platform of choice. Have any trouble finding us on a podcast platform or on YouTube? Well, you can find our channels most easily by going to our website, Nelson Financial Planning, and upper right-hand corner, a bunch of icons. Click on the one that looks most familiar to you, and you will get instantly connected over to our channel. Also, while you're there, you may want to check out our blog post as well. We're going to be talking about our latest blog post here later on in the program, giving you some concepts that you certainly might want to be thinking about from an investment perspective. So anyway, certainly some important items to note, if you will, in terms of the inflation adjustments that the folks at the IRS did. The biggest one, or I guess let me start with the caveat. So these adjustments refer to the tax rates and the standard deduction and the tax brackets and things like that for the year 2023. Okay, so what that means is that you're not actually going to see that play out until you file your taxes, which would typically be in April of 2024. But what you might see is a little bit more net pay, higher take-home pay in your paycheck as a result of these inflationary adjustments. Because see, what happens is the tax brackets, or the amount of income that is subject to a particular tax rate, 12%, 22%, whatever the case may be, with inflation, right, then those numbers would push up. So dollars that would have been taxed at 22% this year, 2022, in 2023, because of the inflation adjustments, are now taxed at 12%. And so when you look at how those numbers shifted, you're talking about maybe, a couple $100, give or take. So if you're getting paid every couple times during the course of the month, then you may see maybe a $15, $20 net increase in your paycheck. So that's what the folks in the mainstream media were all talking about this past week, is how, because the IRS announced these adjustments this past week, is how, inflation is going to help you save money on your taxes and ultimately increase your pay. That's what's going on. It has to deal with the withholding. It has to deal with the fact that the income tax brackets ultimately shifted up, or a little bit up. And so consequently, income that this year taxed at 22, now going to be taxed at 12%, because those brackets, or those bracket ranges, sort of all shifted out. Net effect, probably a couple $100, give or take. So nothing really to get overly excited about. That is for sure. Similarly, same thing on the standard deduction. Standard deduction increased by $1,800 up to $27,700 for a couple, $13,850 for a single. Again, an $1,800 increase for a couple translates to basically maybe a couple $100, right? As you're shifting maybe a little bit of money out of that 22% bracket to the 12% bracket. So those are the biggest ways that inflation, quote unquote, could save you on your taxes, give you more money in your paycheck. Simply put, because the tax tables all kind of shifted up, or the income tax levels all shifted up, so that some of the income that was previously taxed at 22 is now taxed at 12 because of these inflationary adjustments to the tax bracket, and similarly the inflationary adjustment to the standard deduction. Similarly, other things like earned income credit increased up to the maximum, increased up to $7,430 from $6,935. HSA contribution, again, remember 2023, these numbers refer to, for an individual, increase of a couple $100 to $3,850. Family, $7,750, an increase of about $450. So those are the kinds of things that expanded. Estate tax exemption increased from just slightly over $12 million to about $12,920,000. So again, congratulations if you've got to worry about that problem. Not many people do, because what that means is that basically you have to have 13 million, or over 12,920,000 of assets when you die in order to have to pay estate tax. And that's a per person level. So if you're a couple, two people, multiply that by 2. Gift exclusion, the amount of money that you can give to people and not have to worry about it creating any gift tax consequence, is going to, for 2023, going to increase to $17,000 from $16,000. So those are the ways in which those inflation and how the IRS adjusts those those numbers based upon inflation. Similarly, there were some adjustments on the maximum contribution limits for retirement accounts, and we're going to talk about that after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the inflation adjustments that we saw this past week. In the prior segment, we mentioned some of the adjustments that had happened that impacted what particular tax bracket you may fall in. And so consequently, you may see a little bit more in your paycheck, really, unfortunately, a little bit more, because while these brackets change some, and probably they change the most that they have in many years because inflation is as high as it is, when you start to kind of normalize that on a paycheck basis over the course of the year, you get the point. It's not really dramatically noticeable. What is dramatically noticeable, though, if you are saving for retirement, is that there were also adjustments for the amount of money that you can contribute to your 401k, your IRA, things like that. Now, remember, everything we're talking about here is for 2023, right? So you won't see really any of those ripples until we get to January. But if you like to maximize out your 401k, your 403b, your 457, know that the contribution limit went from $20,500 up to $22,500 for year 2023. If you're over age 50, you get a catch-up, and that catch-up also went up from $6,500 up to $7,500. So you can put a total of $30,000 if you're over age 50 into a qualified retirement plan that your employer offers. So that is certainly good. Again, the tip there is if you are maximizing that out over the course of the year, then make sure you adjust the amount of money that's getting contributed to 401ks, 403bs, 457s, and the like in order to get to that maximum limit, because it did in fact increase. This year it's 27,000. Next year it'll be 30,000. So a bit of an increase there. Similarly on the IRA, if you're putting like $500 a month to fully fund it, well, then you need to increase that, because the new IRA limit for the year 2023 is $6,500. So those are the kinds of things that will play out. The reality is that a lot of those adjustments are normal. Unfortunately, and we've talked about this on a regular basis on the program, the adjustment that doesn't happen is the threshold for taxation of your Social Security. That one not pegged to inflation. Good thing at least your Social Security is. The reality is that there is no adjustment in that threshold that triggers inclusion of your Social Security on your income tax return, as there hasn't been for 30, 40 years, because that one is not inflation adjusted. So a host of things obviously getting adjusted, but some things aren't, particularly the item with Social Security and the taxation of Social Security. So those are the inflation adjustments. A lot of talk on that this past week. So we thought we would go over that with our listening audience here on the program. Also this past week, so obviously we're getting close to an election season, right? So I guess it happens on a regular basis every couple of years. And so get a lot of talk about politics. Election day, 2 weeks from Tuesday. Hard to, it's coming right up. Hard to believe how quickly that is. And I guess, to be candid, I would say that both parties are a bit of a disaster. Okay, I don't know if you share that sentiment or not, but both parties passed COVID stimulus bills that were simply unnecessary, leading directly to the inflation and the pain that America is feeling. And make no mistake about it, those that feel inflation the most are those with the least amount of money. So it is very regressive inflation when it comes to that. And then the Republicans passed a COVID bill in December. Democrats followed it up in March with another one. I think in retrospect, 3 separate COVID bills may very well have been overkill. My personal view, throw them all out and term limit the new ones that come in. But unfortunately, I don't know that is going to happen. But it is certainly shameful what happens in Washington. And sadly, it goes well beyond the politicians. Again, we talked about this at the beginning of the program. I don't know if you've been following this investigative piece by the folks at the Wall Street Journal, but we want to just share with you some of the conclusions that investigative journalism has drawn, looking at the trading records of federal officials. So it's Washington, period. It's not just the politicians, but the federal officials are absolutely taking advantage and not behaving in a way that you and I are expected to behave as citizens. So we're going to just read a bunch of this in terms of the highlights. So bear with us. We don't normally kind of read, script stuff, but I think this one is important so that you can understand what's going on and what the conclusions of the investigative piece of the Wall Street Journal It is, and so we encourage you to obviously read the full investigative piece. But here's what it here's how they have described, or the conclusion, if you will, of their investigative piece that they've done on federal officials and trading. The timing of trades by a wide range of federal officials was, quote unquote, exquisite, particularly with respect to top-level information about the origin of the pandemic, its spread, and the government response in form of trillions of dollars in COVID relief and the stabilization of the financial markets. That is the conclusion that the folks at the Wall Street Journal have done based upon a timeline of official COVID events, financial disclosure forms, and emails obtained through public record requests. I'm just going to read a variety of some of the stats that the folks at the Journal wound up coming up with. And it's political season. We understand that. It's all in everybody's mind. I think I speak for a lot of folks that say that all these politicians are complete disasters. Throw them all out and term limit the new ones. Sadly, I don't know that we'll ever see that. But it goes deeper. It goes deeper in Washington than just the politicians. And when you start to listen to kind of some of these things that we're going to share based upon this Wall Street Journal analysis of the trading patterns of federal officials during COVID, and you probably come to the same conclusion. So here we go. More than 1,800 of federal officials reporting owning or trading major technology stocks as the U.S. ramped up scrutiny of large tech companies. More than 200 senior EPA officials. So these aren't just the politicians that we elect. These are the people that are in federal government running the departments, running the show. More than 200 senior EPA officials, nearly 1 in 3, reported investments in companies that were lobbying the agency. 1/3 of 90 senior FTC officials owned or traded stock in companies that were undergoing an FTC merger review or investigation. About 240 officials of health agencies and the Pentagon, which was in charge of COVID vaccine rollout, owned stock in the drug manufacturing and biotech companies that ultimately won the contract. About 160 officials of 50 agencies bought stocks in travel and leisure companies that received billions in federal aid with above average volume. And again, that word, exquisite timing. Treasury Department officials, as a group, reported 30% more stock and fund purchase in February 2020, which is just prior to when the economy was shut down in COVID and all the stimulus bills started rolling out, as the feds were preparing to cut rates to zero. Then a 30% increase of stock trading over the prior 12 months. More than 6 U.S. officials at 5 agencies reporting trading stock in companies shortly before their agencies announced enforcement actions against them. About 70 U.S. officials reported riskier techniques such as short selling and option trading, some valued at between $5 and $25 million. When financial holdings caused a conflict, the agencies simply waived the rules. That doesn't give you an indigestion on a Sunday morning. I don't know what does. We're going to continue this conversation when we get back here on Dollars and Cents with Joel Garris of Nelson Financial Planning. I will tell you, if you're interested in learning a little bit more about what we were talking about, I would encourage you to go over to the Wall Street Journal website and take a look at that investigative analysis that they have done in multiple parts over the course of the past couple of weeks. It really will just cause you to shake your head. I mean, this is obviously a political season, 2 weeks before the elections, and a lot of talk about politicians. And I think I speak for a lot of Americans who say that they are disappointed in the quality of the individuals that are running for office these days. And so when you look at the investigative piece that the Wall Street Journal did, it is just shocking to sort of read what the data showed in terms of not behavior of the politicians, but of the federal officials that are all up in Washington that are running these departments. Some really disturbing stuff, and we certainly spent a lot of last segment rattling off some of the conclusions that the folks at the Wall Street Journal had based upon analysis of some pretty extensive data of the trading patterns and the financial disclosures and emails of what was going on or the behavior that federal officials were engaging in. In a word, pretty shameful. And I think hopefully this might start a conversation of how you might be able to keep those federal officials a little bit more accountable than what they have been. That is for sure. So we encourage you to check that out for more information, or if you've missed any of those details, don't hesitate to check out this program on a podcast platform, because we will be obviously putting it on to the various podcast platforms tomorrow. So you'll be having an opportunity to kind of listen in on that again. But certainly some very troubling trends, if you will. Speaking of trends, we talked a little bit about market volatility, and appropriately enough, one of our most recent blog posts talks about some of the things that you need to be considering from an investment perspective in terms of creating an investment portfolio. So we thought in this segment, we would sort of hit the highlights, if you will, of what the overall content of the blog post is. Of course, if you want to learn more or listen or read more of the details for the blog post, simply go to our website, nelsonfinancialplanning.com, and you'll see the full blog post. But that post talked about some of the basic parts of creating an investment portfolio, right? Pretty timely, hopefully timely. Think of it as timely information in a volatile market. And so the first thing, I guess, in terms of creating that investment portfolio is you have to decide what you want out of it. What's your investment objective, if you will? And that deals with thinking about things like risk tolerance, your time horizon, and understand that you can have different risk tolerance and different time horizons for different parts of the portfolio, right? I mean, some of the stuff may be more longer term. Some of the stuff may be more shorter term. Important to have some, perspective in terms of performance and performance expectations in terms of what that looks like. So it starts with, okay, well, what do I want? What's the objective here? And then from there, you would shift into, okay, well, what should I invest the money in? Well, there's a slew of different options. Usually it boils down to stocks, bonds, cash, mutual funds. Mutual funds basically just different collections of stocks or bonds. The difference between stocks, of course, higher return, more volatility, bonds, lower return, really low return this year, particularly as interest rates are really moving up dramatically. Some of the performance of these bonds, whether it's tax-free munis or general bond funds, is just a disaster this year based upon how much interest rates have been going up. But that's a decision, right? That, what should I invest in? How much in each percentage? How much do I keep in cash? Things like that. And then deciding how to fund your investments, right? Do you do that on a regular basis, or do you do that as part of the overall approach of having it saved on a monthly basis as part of your paycheck? Some of that is thinking about setting goals. What do you want to accomplish? Creating a budget is a great way to try and find money that might otherwise be hard to find, and deciding where and what to invest in. Is that an IRA account? Is that an after-tax account? What, in fact, does that look like? So those are some of the things that you'll need to consider, and in terms of creating that investment portfolio. And then lastly, it's, sort of how you do it, right? Time in versus timing. Most important concept that we like to talk about is make sure to pay yourself first. I think all too often people think about investing as, I'll do that. That's the money that I have at the end of the month after I've spent it on everything else. That's the piece that I'm going to invest. No. You want to pay yourself first, and then that way you know that it is getting done. Dollar cost average, great strategy. Dollar cost averaging, putting money in on a regular basis. The team here at the office, Zach and Chet on our Instagram channel have had a couple of different videos about that of late, so we encourage you to also kind of check that out over on that platform. And then understanding how to take the money out, right? How to be tax efficient, how to have the right approach and strategy to take that money out. Anyway, so that's the concepts, if you will, on how to create an investment portfolio, all described in much greater detail on our blog post. So make sure you check that out at nelsonfinancialplanning.com. The reality is that these blog posts sort of start to scratch the surface of what people need. The reality is that a lot of folks need basic financial education and financial education that, in fact, is so structured. In fact, 88% of adults polled think a semester or year-long personal finance course should be required for high school graduation. You can certainly put me in that 88% category. Those are the kinds of life skills that might be useful versus some of the other stuff that gets taught in our educational system. Certainly a personal finance course that talks about spending and budgeting, that talks about cash flow, that talks about managing credit, that talks about saving, earning income, investing, managing risk, things like that. A very high percentage of the population really is clamoring for ensuring that the next generation is more informed than them as it relates to their finances. So hopefully, speaking of the politicians, maybe that's something that they could actually do that would be worthwhile, of ensuring some kind of a real learning opportunity, if you will, for finances and budgeting and how to save money. I guess stay tuned on that one. Anyway, we're about running out of time for this week's episode of Dollars and Cents with me, your host, Joel Garris of Nelson Financial Planning. If you liked what you heard and want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you change your life with a successful and cost-effective financial plan, go to our website, nelsonfinancialplanning.com, and fill out the Contact Us form to set up an absolutely free conversation. Or, in the alternative, you can actually just pick up the phone, call the office, 407-629-6477. We still got humans that answer the phone. Isn't that amazing? And remember, we don't believe in account minimums at Nelson Financial Planning because our purpose is to help you get a financial plan with better results at a lower cost. Thank you all and enjoy the rest of your Sunday.